CPA. I prepare tax returns, also do uh, month-end bookkeeping for clients and things like that. And I have a business relationship with Kelly Martinez and with Fine Nest Realty, and she was kind enough to coordinate getting a group of us together to sort of go over these last minute tax changes that will be impacting 2018 tax returns and so forth. So some of the big changes, which are getting a lot on the press, are the limitation on itemized deductions as it relates to state and local income taxes and real estate taxes and personal property taxes. And so the limit where they used to be at unlimited deduction and phased out in higher incomes and things like that, they are now being capped at 10,000 max. So that's a combination of the state income tax, the real estate taxes, and personal property taxes. The maximum you can deduct on your Schedule A for either single person, married filing jointly, head of household would be 10,000. If you're married filing separately, it would be 5,000 on each of your returns. So that's the probably the biggest hit that people will see in 2018. One of the other changes related to medical expenses, and prior to, I think it was 2015, the deduction that you could take on Schedule A was anything that you spent above 7.5% of your adjusted gross income. And the last couple of years, that changed to 10% unless you were over 65. And what the new tax law has done is it brought that 10% down to 7.5%, and that would be that's the only piece of the new legislation that's actually retroactive to 2017. So if you had large medical expenses in 2017, you would now potentially be able to deduct some of them with the lower percentage. And so the 7.5% is for 2017, 18, and 19, and then it will revert back to the 10%. The other itemized deduction that's is used a bit more readily by clients is the miscellaneous deductions. And these were expenses such as your tax preparation fees, sometimes legal fees related to financial planning could be deducted. If you have investments and you pay broker fees and things like that, those would also fall into the miscellaneous itemized deductions. There was also a safe deposit box fee. If you paid that at the bank, that would be under the 2%, as well as any unreimbursed job expenses. These would be if you were a W-2 employee and maybe you had licensing fees, dues and subscriptions and things like that that your employer did not reimburse you for. You can group all of those miscellaneous itemized deductions, and if you reach the threshold, which was anything that you spent over 2% of your adjusted gross income, would also become part of your itemized deduction. That those miscellaneous deductions are off the table as of 2018. So if you have any dues, if you generally meet the threshold and use the miscellaneous itemized deductions on your Schedule A, and you have any dues or licensing, things like that, that you would be paying for 2018, you might want to try to get those paid before the end of the year, realizing that it is December 27th. So that would help. As far as the real estate taxes, the IRS has said they'll take the prepaid real estate taxes, but that's also dependent on the jurisdiction that you live in. So Fairfax County, Montgomery County, Loudoun County, you'd need to check with your local jurisdiction. I know Fairfax County online, you could make a payment, but they specifically said on their website that they're not guaranteeing that it's going to be processed before the end of the year. Montgomery County in Maryland this morning just passed that they will accept the payments, but again, you'd probably need to go online to each of the jurisdictions and make an estimate. And probably the best guess is what you've paid in for 2017, and then everything will be trued up in 2018 when the assessments actually take place. Now, a couple things to consider if you end up making that option and prepaying the taxes. If you generally have those payments coming out of your escrow, you may want to check with your mortgage processor and see if maybe they can lower your monthly escrows for 2018, since you would have already paid the taxes in there. So that just to gain a little bit of cash flow, since you're going to potentially be outlaying a lot. The other thing for Fairfax County, Loudoun County, you also have personal property taxes on your car, and I believe they were accepting those as prepayments. What the IRS said they were not going to do is allow you to deduct prepayment of any state and local income tax. So, so those would not be prepaid. What is not clear is, or at least from what's being presented, that's out there now, is whether, some people who generally make quarterly payments, things like that, sometimes have an overpayment that's then applied to the next year. And so I don't think those are going to be an issue, but they said they were not. And again, I'm not exactly sure how they're going to control what's deducted and what's not deducted as far as prepaying the state income tax. But that was definitely clearly stated that they would not be taking that. Now, some of the other highlights were also related to the mortgage interest. And so any mortgage that's existing is grandfathered in, but there was a limit on if you had a mortgage that was in excess of $1 million, you were limited by the interest expense. You couldn't take the full interest expense on a mortgage over $1 million. That $1 million is now being lowered to $750,000. So in some of the high real estate market, that may come into impact people buying houses in 18 and subsequently. The other large change was that they are no longer going to have the personal exemption, which was $4,050 per dependent on your return, and per exemptions that you were taking on your return. So a family of 4 would have 4 times $4,050. And so one of the things they've done to, in essence, try to mitigate that is they've increased the standard deduction. So up through 2017, if you were married, filing jointly with no children, your standard deduction would be $12,007, and you would have had a personal exemption of $8,100, which would mean you had $20,800 coming off your adjusted gross income to lower what your taxable income was. So going forward, 2018, that $20,800 changes to $24,000 for the standard deduction. Now, the difference is if you were itemizing and you had more than 24,000 itemized deductions, you still would also have the 4,000. So some of it's mitigated, some of it is definitely a loss to people who were itemizing. If you were taking the standard deduction, not using Schedule A, then you're a little safer with the changes that are in place. The other large change was for children under 17. The tax credit was going from $1,000 to $2,000 per child under the age of 17. Again, there were thresholds where the $1,000, if you were in a higher income level, you did not benefit from the tax credit because it was phased out. And for a single or a married couple, the phase out was $75,000 and $110,000 respectively. Those thresholds are now going to increase to $200,000 and $400,000 from 2018 through 2025. And so, so that's a little bit of a benefit, and those are tax credits, which means it's a dollar for dollar off your tax. So if your tax liability was $10,000 and you had 2 kids and you qualified, you would have $4,000 taken off the 10, and your tax liability becomes $6,000. The other change is that 529 plans, which most people were contributing to and going to use that for college for their children, those college funds can now be used to pay private school for grades kindergarten through 12th grade. So you can get maybe a little bit of cash flow savings to be able to take some of that money out now to use. The other big item was the Affordable Care Act, which had a penalty if you didn't have health care in 2017, and that will still be the case in 2018, but this bill repealed the mandate on having health insurance for 2019. So those are kind of and then the other big change, I'm not going to go over all the numbers, but the tax bracket changes and the rates that you're going to pay on your income tax definitely were lowered, and the brackets were expanded a little bit. So that's on the positive note of things.
And so, Robin, if anybody wanted to get a hold of those brackets, are you able to email it to them if they contact you?
Yes. So if you can reach me at, my email is robinshoe@mac.com. That's ROBINSHOE @MAC.com. That's my direct email. I can be reached at my home office at 754-529-8571 if you have other questions, or email me and we can coordinate any questions that you may have. And then I can also forward, for those requesting, the new tax brackets, and it shows a comparison of 17 and 18. So a couple things to consider for those who are self-employed and possibly have a home office is taking a home office deduction. And what that will do is, since your real estate and state income taxes are now maxed at $10,000, if you can shift some of your real estate taxes over to the home office deduction piece, that will help. Another item that changed for 2018, and this changes all the time, is the standard mileage rate is now for 2018 will be 54.5 cents per mile. So if you get reimbursed by your employer, or you're self-employed and you track your own mileage, you should be taking a deduction of 54.5 cents per your business miles if you're using the standard mileage rate. If you're using the actual car expenses, then it's actual car expenses times the percentage of business use. So those are a couple of things to keep in mind when you're doing that. Some other things to try to help just general tax planning strategies is if you are an employee, you have W-2 income, you might want to consider starting to maximize your 401k contribution. What that will do is that will lower your federal taxable income as well as your state, which then lowers your the taxes and your state taxes. And keep in mind, you may not be getting the full benefit of all the state taxes you paid. So anything you can lower helps you. A couple other things to potentially consider. Does anyone have any questions so far on anything?
I'm going to unmute the lines for a second and see if anybody has any other questions. I also opened the chat box too, so if you don't want to talk, you can type. Okay, I'm going to go ahead back and mute the lines. Can everybody still hear us?
Yes.
Okay.
Heading your way.
Did anyone have any questions?
No, I don't think so. Okay, Robin, I just went ahead and unmuted you again. So I think we did have the one question from Lisa, so I'm going to send this to her as a recorded session, unless she dialed in as the number that I can't see what the person's name is. But that was in regards to the 401k account, being able to withdraw. I'm not sure if you had any material on that or if she can reach out to you for more specific information.
I didn't find anything that was on point for using funds for a second home. One of the things, if it's a 401k, is sometimes you're allowed to borrow from that. And if you borrow from it, then it's just paid back through your W-2 on every time you get paid, a little bit's paid back. So it's just like a loan, but the difference is you're borrowing money from yourself. That money is not taxable to you at the time you get it, as long as it's all paid back. Now, and then you're paying yourself interest on that loan into a tax deferred account. Now, having said that, if you end up leaving your employer before that loan is paid back, there's generally rules for that. So either you have to pay it back, the balance due within a certain time frame of leaving the company, or they would issue you a 1099 and the balance that was unpaid becomes income to you, but it's also potential to the early withdrawal, the 10% penalty. So you want to just be careful on borrowing, making sure you'll be able to pay it back without the income tax isn't so bad, but getting the 10% penalty can be pretty significant.
All right, so if we don't have anything else, go ahead.
No, we discussed the prepayment of the taxes. Anything else that you can prepay, like I said, for the 2% deductions, if you maybe get with your brokers and see if they'll, if you're charged a fixed quarterly fee, I don't know, maybe they can bill you for that before the end of the year, take that out of your account and get good use of that. So any types of expenses to sort of lower your income with whatever mechanism that is, whether it's the real estate taxes, whether you're if you're self-employed or you own a business, if you have, if you're thinking of buying computers or any large ticket items, maybe January, February, maybe try to buy that before the end of the year and accelerate your deductions in 17. Because in 18, again, the rates go down a little bit, so you're better off accelerating some of your expenses in 2017. The other itemized deduction I didn't talk about was charitable contributions. If you were generally someone who itemized, but now in 2018, you may be someone who uses a standard deduction, while it's nice to give to charity, you're not going to get the charitable donation anymore. So again, if you think you may fall into that category, you may want to, in the next 4 days, make some contributions to charities. Again, that's not a dollar for dollar deduction, but it's usually, depending on your tax bracket, between 20 to 25% on the dollar that you're getting the tax benefit for. So that could be something else to try to itemize. For those who do have 529 plans or are considering them, they do lower your state tax if it's not the prepaid one. And then generally speaking, you can have as many plans. So if you're a married couple and you have one child, you can actually have 2 plans, one under each parent's name for that child, and get the benefit of contributing more to that. And again, lowering your state income tax, because once now that this is in place, you're going to be potentially limited on your state income tax deduction. So anything you can try to do to lower your state income tax liability will help.
Mm-hmm. Yeah, I think this is really good information, especially for this area. We primarily focus in the Northern Virginia market, and we do have some of the highest property values as well as income in the country. And so anything that we can do to kind of offset our taxes is always helpful. I think the other thing I just wanted to ask quickly is, did the portion of the proposed bill before where they were changing the capital gains from it had to be 2 of the last right now, or how it was before, it was that it had to be a primary residence for 2 of the last 5 years. I know they had talked about changing that to 5 of the last 8 years, which would really impact.
Yeah, I did not see that in the last thing that I've read.
Okay. If you want to pull it up later, we could always add it to the comments too, just to make sure. But I know that that's one of the things that impacts us as well.
Right. Now, just touching back a little bit on the real estate taxes, if you have rental properties and things like that, that's a separate real estate, and that goes on Schedule E. So those are not part of that $10,000 limit, as long as it's not, because it's a rental property, it's considered a business, and that's where that would go versus Schedule A.
Okay.
The other thing for the, just real quick back around the home office, you can either do a percentage of actual expenses on the so like that would be your mortgage, your real estate taxes, if you have HOA or condo fees on your home, your utilities and things like that. You would take, say your home office is 5% of your house, you would take 5% of that, and that would come off your self-employed or pass-through income, however you're set up as your own business. The other option is still the simplified method, which is $5 a square foot, up to $1,500 as a deduction. So, if you have your own business, there may be some ways to sort of shift some things over from Schedule A and, try to utilize everything that you possibly can. Okay.
Awesome. So if anybody, I'll open the lines one more time. And then if anyone has any questions, again, you can also type in the chat. Any questions from those on the line?
Hi, this is Millie. I think I dialed in a little bit late, so I kind of missed the part about the mortgages on the taxes. So can you just try to go back to kind of give me a brief summary on the properties and the taxes and the mortgages?
Okay, so the real estate tax, so what has changed for 2018 is they've said the maximum of $10,000 of a combination of real estate taxes, state and local income taxes, and personal property taxes those three combined are maxed out at 10,000 for single, head of household, and married filing jointly. If you're married filing separate, it's 5,000 for each of you. And so some of the jurisdictions, I know Fairfax County was saying they would accept prepayments of your 2018 real estate taxes, but it was, since we're this late at the end of the year, they were not guaranteeing that everything would be processed timely as a 2017 payment. I know Montgomery County just came out this morning and they passed that they'll accept that as well. So you'd have to go to each of your own jurisdictions and see if you can make a payment. Some of them take ACH, some of them take wires, some may take credit cards to make those payments and see if you can get those into 2017 versus 2018. And the other thing I had mentioned about if you are successful in doing that and your real estate taxes are generally escrowed and paid through your mortgage company, you might want to just contact your mortgage company, show them proof of the taxes being paid, and maybe they can potentially lower your escrows for 2018. So at least you're not double dipping into the same dollar for cash flow purposes. But the state income tax, state and local income tax itself was not being allowed to be prepaid.
Okay.
Did that answer your question?
Yes. Yes, that does. Thank you so much.
Sure.
Okay, so I don't believe we have any other questions, but Robin, thank you so much for your time today. And again, if any of you would like to contact Robin, she's been my accountant and my business partner's accountant for a couple of years now. She's absolutely fantastic. We are a hot paperwork mess, and she's always able to take care of us, so we appreciate her very much. And her phone number is 754-529-8571, or you can also reach her by email at Robin, ROBIN, Shoe, SHOE, at, is it me.com or mac.com, or does it matter? Either one works. Okay.
It comes to the same, so that's
awesome. All right. Thank you so much again, and I hope everybody has a great day. Thank you so much for joining us.
Happy New Year, everyone.
Thank you.
Thanks, Kelly, for the opportunity.
Mm-hmm.